Good afternoon, and welcome to DripsMedia. It's Friday, October 24th. Tonight, we are tracking several major economic stories from around the globe. The U.S. trade deficit has surged to a 4-month high as imports significantly outpace exports. Meanwhile, the American economy shows broad strength with GDP rising in 48 states. Across the Atlantic, the Eurozone's private sector is expanding at its fastest rate since May of last year, driven by a boom in services. Back in Washington, a potential government shutdown threatens to delay the release of critical economic data, creating uncertainty for the markets. The U.S. trade deficit surged to $78.3 billion in July, a 32.5% increase from the prior month. This significant jump was driven by imports rising 5.9% to $358.8 billion, outpacing the modest 0.3% increase in exports. The widening gap is partly attributed to companies accelerating imports to get ahead of potential new tariffs. The goods deficit alone grew by $18.2 billion, while the services surplus saw a decline. The Eurozone's private sector is showing robust health, reaching its most significant expansion since May of 2024. This impressive growth is being powered predominantly by a substantial rise in the services industry's output. The strong performance in the services sector indicates renewed business and consumer confidence across the member nations, suggesting a positive economic trajectory for the region heading into the final quarter of the year. A look at the United States economy reveals widespread growth in the second quarter of 2025 as real gross domestic product increased in 48 states. The national real GDP grew at an annual rate of 3.8%. Leading the charge was North Dakota with an impressive 7.3% increase. The primary drivers behind this nationwide economic expansion were the finance and insurance information and non-durable goods manufacturing sectors. Only Arkansas and Mississippi saw declines during this period. In Washington, uncertainty looms as a potential U.S. government shutdown threatens to disrupt the flow of crucial economic information. A shutdown could delay the release of key economic data, including the highly anticipated National Jobs Report. This would leave investors, policymakers, and the public in the dark about the health of the economy at a critical time. The delay could introduce significant volatility into financial markets as traders operate with incomplete information.